Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm very good, Bryce. Very excited for this episode. As you know, we're big proponents of reading investment books and just reading in general on this show.
Yes.
And so we've got an author who's written a great book about investing, which I'm excited to get stuck into.
Absolutely. Not only are we advocates of reading, but reading things that keep it simple. That's our motto here at Equity Mates. Well, I've just made that our motto. It is our pleasure to welcome Danielle Ecuyer to the show. Danielle, thanks for coming on.
Thank you, Bryce. Thank you, Ren. This is very exciting.
So Danielle trained as a share equities analyst in the late 1980s before relocating to London in the 90s, where she transitioned her expertise to institutional emerging markets, which we'll unpack a bit later. Danielle has worked in senior positions at some of the world's most prestigious investment firms, advising global investment companies. Since arriving back in Australia in 2003, Danielle has used and expanded her skills for her own investment portfolios, covering the Aussie market and the US market. In addition to all of that, as Ren mentioned, Danielle has recently launched her new book, Sharelicity, a simple approach to share investing, which we're very much looking forward to unpacking. So shall we get stuck in?
Absolutely.
Now, before we get stuck into the book, we do like to start these interviews with a bit of a game. We call the game overrated, underrated. Potentially it should be called overvalued, undervalued. We'll leave it up to your interpretation, but we'll throw out an index, a topic, a stock, something that's big in financial markets and financial media at the moment, and get your thoughts on whether it's overrated or underrated. So to kick it off, we'll start at home. The ASX 200 index, overrated or underrated?
I'm going to say overrated, and that's not an evaluation perspective. People often become too caught up in what the index is doing. And as you'll discover as we go down the list, it's a combination of looking at the index, but also looking at what is in the index. And investors really need to differentiate between what an index is composed of versus the total index. So overrated.
Overrated or underrated, the ASX 30?
Again, you actually need to know what is in there because I did some quick numbers for you guys. So we've had a big run in the market today. What are we, the 3rd of July?
Yep. Recording on 3rd of July.
And
2nd of July?
2nd of July. Whoops.
I didn't even fact check that. Yes, recording 2nd of
But
July.
we've heard it here first. The 3rd of July, there'll be a big run in the markets.
Exactly. Anyway, so we're 16% off the high for the ASX 200 and we're 18% off the high. I actually did the ASX 20. So as you can tell, there's different dynamics going on there because of the different stocks in there. And again, if you look at an index, that is fine, but you also need to always look what exposure are you trying to buy.
I imagine the answer for my next question is going to be similar given the index discussion we've had, but I'm going to ask it anyway because it's got some big companies in there which capture a lot of the headlines. So overrated or underrated, the NASDAQ 100 index?
Wow, I hate to say it. I'm a big fan of the NASDAQ, but it is overrated because most people don't realise that there's a whole lot of biotech companies in there. And there's also companies like Pepsi and some of the more old world economy stocks. So again, yes, you capture the big FANG stocks, but interestingly enough, you can capture them in the S&P 500 too. So, again, you just need to have a look. So if you want to get exposure to the big FANG stocks, maybe you need to drill down a little bit more into just let's say an ETF that captures those.
Alec was talking to me the other day about the fact that the FANG now make up, in terms of market cap, 26% of the S&P 500 or something like that. It's ridiculous.
Yeah, it's huge.
Buy the S&P and get 6 stocks.
The NASDAQ, yeah.
But there's some...
S&P, you're right, yeah.
There's some really interesting research from an academic called Henrik Bessenbinder, and he actually looks over time how many stocks actually contribute to the percentage increase in an index. And there's no surprises here. In the last 10 years in particular, you've seen the FANG stocks really overtake some of the traditional stocks. And a classic case in point is Tesla overnight.
Oh, yeah.
Although, funnily enough, in the last 3 years, 2 of the 5 FANG stocks have actually underperformed the NASDAQ
Yeah.
Yeah.
So you're talking Alphabet and
Facebook.
Facebook. Yeah. Well, I'm
Dodgy
not
Facebook,
surprised.
Yeah.
The other ones, all doing very well, though.
So overrated or underrated, the Reserve Bank's monetary response to COVID-19?
Yeah, this is really interesting. I've put underrated, but the Reserve Bank has actually taken a very different stance to what the Federal Reserve has in the US. So they tend to be more tentative about lowering interest rates, and they're also trying to control the yield curve, which is something that the Fed doesn't want to go down. At the end of the day, to get the responses that we need in the economy, you need both monetary and fiscal policy. And I'm sure you guys have heard that time and again in the last few weeks. The Reserve Bank, I think, feels like they've got their hands tied a little bit, but it's probably underrated in terms of how much they have contributed at this point in time.
I was listening to a US podcast today, and they were lamenting for Australian investors because of the Reserve Bank's action to try and hold the yield curve.
Yeah, it seems to be quite hotly debated. We're in uncharted territories across the board in terms of what's going on with monetary policy at the moment. So a lot of people are questioning whether the Fed should actually be buying this high-yielding bad debt in America. Just mention Hertz and the like that. I mean, you're actually creating zombie companies. And really, if economies are meant to evolve properly, you've actually got to have the attrition of the companies that are not going to stay the course. So, it's a bit hard sometimes to just go under or overrated.
Yes, yeah. It's a little bit more complicated than that. But in saying that, we're going to keep asking the overrated, underrated question. So the next one, we have a lot of experts on the show, and there's a real diversity of opinions around buy and hold or stock picking. So next one, overrated or underrated stock picking?
I think good stock picking is underrated. Having said that, a lot of stock pickers have struggled to outperform the indexes over the last few years. And this has caused real question marks because the ETF market has obviously been growing exponentially, and everybody goes, I'll just pile into the ETFs and that's the way to get my exposure. My hunch is, and I'm certainly picking up from the experts, that stock picking may come back more into fashion to get the performance. I've certainly seen it in my own portfolio, particularly in the US. But you also need to then differentiate between the styles, whether you're doing value versus growth. And oh my God, is that a loaded one to go down, but ultimately very important.
I mean, beating the index when we've been in a record bull run for, 12 years or so. I mean, you can see why the argument is where it is at the moment. But when the markets start going down, I think that's where stock picking comes into play a bit more.
Yeah, and also too, as retail investors, why do you have to beat the index?
Yeah, exactly. Yeah.
I mean, this is actually a professional tool for the the industry.
Yeah.
Retail investors, what they need to understand is they're not competing against fund managers.
Yeah.
All they're trying to do is put together a portfolio of investments that suit their risk profile, their age, and their own cash flow. Of course, everybody wants to outdo the market, but at the end of the day, it's not your day job.
Yeah. We spoke to Lars Ecuyer over in London, and he wrote a book called, I couldn't even remember the name of it. Can you remember it? No. Anyway, his thesis was just buy the MSCI All-World Index, and that's it. As a retail investor, why do you need to buy and
Investing Demystified.
Investing Demystified, yeah.
Yeah, that's got its pitfalls too, though, because you have to question whether or not you necessarily want to pick up some of the stocks that might be in that MSCI index. So usually at the end of the day, it's not about absolutes, it's about relatives when you construct a portfolio. So the whole thing is that you can mix and match, but I'm sure we'll get there.
Yeah, I think we'll get stuck into some of these when we get past this game.
Yeah, I was going to say, this has become a long game. Anyway, we'll close it out.
Sorry.
With... No, it's good.
It's a good conversation.
We'll close it out. Overrated or underrated Australian residential residential property?
I'm going to say overrated.
Nice.
Yeah. Yeah. I think people have really, look, it's happened around the globe. You see it in countries like the UK and London. I think people get too much property exposure, and that is being unwound at the moment. It's not a liquid asset like shares. And I think people need to stand back and not fall in love with any asset class.
Except for stocks, because that's all we're going to be talking about today.
Stocks, not stonks, I assume.
Nice.
So moving on from the game, we like to hear the story of people's first investments. We generally hear a good story or some good lessons that come out of it. So to kick us off today, can you tell us the story of your first investment?
Yeah, sure can. I think I just started stockbroking way back in 1985, and I hate to say probably most of your listeners weren't even born then, but anyway. And my mother's friend, who was also a stockbroker, said, you've got to buy this company called Sarich, which did the orbital engine. And as I was explaining to my son, he goes, what on earth was that? And I said, this was a revolutionary new engine that would replace generally all combustion engines for all transport vehicles. And the chap's name who did it was Ralph Sarich, and we're talking Western Australia in the mid-80s. The share price went through the roof. I was lucky enough, got on board. I think I made about 25-30% very quickly. And because I tend to be quite conservative at that stage, I took my profits, thankfully, because poor old Ralph Sarich's technology kind of blew up in his face. Literally, the engine kept on overheating. So the whole company amounted to nothing. Lessons learned, it's beginner's luck. Or luck. Investing is so much about luck. Hubris is very bad if you think you're really smart all the time when you invest. I hate to say it, the share market will come back and smack you in the face so hard. Also, it showed the bubbles when everybody gets so overly exuberant, and the story is great, the big picture is great, but at the end of the day, the technology wasn't proven. So you have to keep things in perspective. If you're going to play these types of stories, and there's a lot of them out there at the moment, you've got to manage your risk.
So has that experience helped frame your investment philosophy as it is today? And do you hold a single investment philosophy, or does it sort of span across many different sort of strategies and ideas?
Yeah, that's a really interesting question. I love quality. Having done emerging markets, I used to call it cowboy country. I mean, and I started in Indonesia, Philippines and Thailand, and trust me, there is a huge gap between really good quality companies and the guys that literally just want to take your right hand. And this was major institutional investment. So quality is really important. What is quality? It comes with a whole lot of features. It comes with good corporate governance, looking after your minority shareholders. You have a moat, a competitive advantage. And in our day and age, you can actually disrupt yourselves. Really important. Having said that, I do have a penchant for new technologies and themes like that. That's why I love the US, because it's just, you can dive right in there and there's hours of learning. And my fiance says I'm a nerd, but I don't care. I just love it.
We are all nerds here. Intermediates into finance.
So, I reckon it's kind of cool to be a nerd in this space at the moment, because the rate of change that the world is experiencing, particularly in this COVID period, is huge. And I don't think anyone should underestimate that. So when I go, I have my quality, then I sometimes play around in themes. I've been in Beyond Meat and, I own Tesla, yada, yada, yada. But, I manage the risk by how much money I actually put into these things, because for every theme there's often a bubble around it.
So, Danielle, the reason we got you on the show was you've recently written a book, Shareclicity, which is a simple approach to share investing. So we want to get stuck into some of the different themes and ideas of the book. But to start us off, can you just tell us about the book, what caused you to write it, and what the major themes are in it?
As I was just telling you, lads, I'd written another 80,000 words in a book that's sitting at home. So this is the second one. And I was lucky enough to find a publisher that wanted a book on share investing. And I said, hey, I can do that. I've been doing that for over 3 decades. We wanted to approach it in the same way as the Barefoot Investor for share investors. So to actually strip out really complex things and make it easy to understand for the person in the street. And having been doing this for quite a long time, I can assure you it sounds simple, but it's actually quite hard to make these complex economics, financial analysis approachable for the person on the street. And I wanted to start at the very beginning, discussing everything from what is this economics, because everybody's eyes glaze over and they have no idea, and then work all the way through of how to look at shares, how to analyze shares, how to put together a portfolio of shares. And I've done it for all different types of people, demographics, everything. So it's really a woe to go for share investing principles, but it's also as much for new as well as existing share investors.
Yeah, nice. So we went through and read the book, and admittedly it is incredibly simple to understand and read, which I think is fantastic and will be of great value to our audience. So we picked out a couple of sections from the book that I think would be of interest to our audience, given the questions that are consistently coming through on our Facebook page and whatnot. So one of the themes that they consistently talk about is financial metrics. Depending on what your strategy is, what you're investing in, there's 1,000 different metrics to look at, and knowing which ones are important is often difficult. So from your point of view, Danielle, what are 3 financial indicators that you use when researching a company, and why are they important?
Okay, you've probably got to go to the basics. You've got to look at the price earnings multiple, which is an indication of the value of a stock based on its future earnings. People also, particularly in Australia, look at the dividend yield, which is obviously the percentage of income that is derived from the shares. But in my humble opinion, one of the most important you've got to look at is some form of debt matrix or cash flow. So it's particularly important at the moment because interest rates are so low and a lot of companies have borrowed a lot of money or using their borrowings to expand via acquisition. There's nothing wrong with debt. Debt can be great as long as you've got the cash flow to service it.
Or the Fed.
Yeah, but trust me, there's going to be a lot of companies that go bust that will not be held up, so whether or not you want to look at a debt to equity ratio or a debt to assets or an interest cover, and I go through all of these in the book. So 2 of them valuation measures of some degree, and then the other one is kind of the strength, the financial strength of the company that you're looking at.
If we look at those metrics, what are some red flags in those metrics or in other metrics that you particularly look for and that investors should be aware of when they're looking at the company's financials and some of these key metrics?
There's a huge difference, particularly in the Australian market, between some of the cyclical stocks, the banks, which I call cyclical, which trade on lower PE multiples and higher dividend yields. And then you go to the healthcare stocks, technology stocks, they typically have a much higher PER and a much lower dividend yield. What retail investors need to understand is just because something has a low PER, it doesn't make it a great buy. And this is the classic value trap that people get caught in. Equally, just because it has a high PER doesn't mean it's a bad company. You always need to look at the relative movement of where the PER, where the yield are relative to the historical. But the ones that people most get trapped in, they say, I can't possibly buy that share. It's too expensive.
Yeah.
Okay. Someone said that to me at Amazon at $700. Well, it's about to crack through 3,000. No, that was a very, very big hedge fund manager in London who's a friend of mine. So don't underestimate that all these metrics, when you look at them, you need to put them in the context of what you're looking at. So a cheaper share with a low PER can become expensive, and equally a high PER company can actually become less expensive.
Yeah. A2 Milk has had a PE ratio of 60 for years, and a couple of our mates have been like, it looks good, it's an interesting stock, but it's too expensive. And it just keeps growing its earnings, but they never bought in.
Well, Amazon's PE is still 137. So if you look at that on its own, you'd be thinking, oh my God. But I'm interested why you're mentioning dividend yield as a metric that is important, because obviously me personally, I rarely look at that as something that is of
Fair
importance
enough.
to me. And I probably, why, but I'm wondering, do you think it's something that millennials should be looking at, or perhaps why is it important to you?
Well, there's 2 things. In a bull market like we've got at the moment, you can probably throw the dividend out with the baby in bathwater. However, the top performing stocks, certainly in Australia, have, and I think there is evidence to prove that the best performing shares over time do have a dividend and they can grow that dividend. It's just a very low yielding relative to the value stocks. I don't think there's anything wrong, even in millennial or even in my son's, because he's, Gen Z, having some of those types of shares in the portfolio. Because at the end of the day, if something happens, you still get some money for your investment. And, it all becomes about how you balance your portfolio. If you don't want to look at dividends, the other one then in terms of important metrics would be looking at cash flow coverage for your companies.
A common question we get around dividends is around dividend reinvestment plans. How do you think about them? Do you take the cash, or if you like the company, you say, let it ride and put that dividend money back in?
I'm not an expert on DRPs, but from an accounting perspective, they're a pain in the rear end. Personally, I think you don't necessarily always want to reinvest the dividend into the same company. So I tend to think if the cash comes in, I can allocate it to the shares that I want to, which may not be the same share. So I tend to think, being the control freak that I am, I'll pass on the DRP.
Yeah, I think that's sort of where we land. It's true. If you love the company, sure, go for it. If you want the cash, find a way to put it back in the market. Don't spend it at the pub, or as Bryce likes to do on the pokies.
Not true. So, a quote that we pulled out from the book, shares like this, and this was in reference to A2 Milk, don't come along very often. So you need to recognize when a share is a game changer for wealth creation.
Yep.
What are the signs that a stock is a game changer for wealth creation? Because I'm looking for it.
Yeah. Unfortunately, it's sort of you have to go with a wing and a prayer sometimes. I cited A2 Milk because at the time I was, driving somewhere and I heard the CEO, who's a very good marketer, talking about A2 Milk. So the protein, the fact it's lactose intolerant, we're talking 4 or 5 years ago, the whole clean green thing, the whole China market. Had a look at it. It looked like, these are the important points, a unique competitive advantage. It was hooking into a secular growth market, which was the Chinese market. It looked like it had its supply issues in train, so it could get the supply. And to me, it sounded like a really good story. I'm amazed how much it's actually run. And of course, when you get a company like this, you get a lot of Me Too's following in. And that's what's also happening at the moment. So the big guys, the Nestle's, etc. So really, you're looking for secular trends, unique competitive advantage, a good moat, and probably a reasonably, well, it's a bit hard because people that pick Netflix, I mean, no one would have picked what happened there, would they?
Yeah.
Borrowed so much money, but they have actually changed the world. So I think at the moment, you're really looking for companies that can actually disrupt the world, and very good companies are very good at disrupting themselves, and that's really important.
I guess the key message and the positive part of that is at that stage, you're just keeping your ears and eyes open to understanding what's going on in the world, and you're not necessarily having to get deep into a bottom-up approach of analysis of balance sheets and screening and that sort of stuff, which I think for our listeners is important. You got into A2 Milk, didn't you, Ren?
I did.
What was your thesis?
Well, it was the second stock I ever bought, and so my thesis was pretty ill-formed. Right after I bought Slater and Gordon, so I've really
you've done yes, the
really
good and the bad and the ugly.
I mean, we often talk about the first lesson that people learn, and I lost 99.5% of my money on Slater and Gordon and have done very well on A2 Milk. And for me, the lesson was asymmetric upside. You can make a lot more than you can lose. But my thesis at the time, I think, was the China story, the amount of lactose intolerant people. It was a pretty ill-formed thesis, but I'm pretty happy with it.
But it's actually not. I mean, at the end of the day, you were right, because it is that unique selling part of the thing.
Either lucky or right.
Yeah, exactly. And luck has a lot to do with it.
Yeah. We mentioned at the top of the show stock picking, and in your book you wrote, set and forget approach isn't always sensible. You need to review your funds. And as Bryce said, we've had plenty of experts on who would strongly disagree with that and say just take the market average over the long term, all of that. Broad-based market index over decades is all you need. So can you tell me why they're wrong to start things off?
Yeah, really easily. Well, I don't know. I mean, your viewers probably haven't bought into Woodside and BHP and NAB, but I can assure you that I was looking back at some old share trades I had. So BHP was $50, Woodside was $60, and NAB was $38. Well, hello. Woodside, I haven't actually looked because I don't really cover it, but 20, I don't know, are we 8, 15, 20? It's absolutely collapsed. And
21.77.
21, okay. Well, it was $60. Thanks for coming. And, so the point is they're blue chip names. Another one was AMP. There was a takeover bid for it at $25. So what are we, $1.50 or $1.80 if we're lucky?
Yeah, 180.
I think to be fair to their argument, they're not talking about individual stocks here. They're talking about broad-based market indexes.
Oh, okay. Yeah. Well, if you take that view, yes, clearly, the Australian market has returned, including dividends, 11.8% per annum since 1900. I always think the benchmark historically, total return, so income plus capital appreciation around 10% per annum. You necessarily can't expect that going forward.
So you also mentioned sort of selling the funds that aren't working. It's an interesting approach because, Alec and I, we've actually just bought into one of the funds, Magellan, and you kind of look at, you could watch them year on year, and if they underperform and get rid of them. But then if you take that long-term approach and that mean reversion sort of idea, it kind of feels like that if you're selling the losers, how do you know that you're not selling too early, and are you giving them enough runway? How do you think about that?
Well, if you're speaking about ETFs or funds, you have to understand, the mandate of the fund or the ETF and what's in there. You've taken Magellan. I assume you're doing one of their global funds?
Yeah.
Yeah. Okay. Well, that makes sense. I mean, they've got a great track record. They're very good at what they do. They're progressive in the way that they think. So that's a slightly different kettle of fish. I know that there are some products out there where they asset allocate for you and they put you into emerging markets, for example. Look, the whole emerging market story, and having done it, emerging markets have been emerging for a very long time. Okay? So, I was lucky. I was on the other side of the coin. I was stockbroking in it. It was great bull market times. But emerging markets are more related to the US dollar than anything else. And trust me, just because you buy the index of an emerging market does not mean that you're going to get the return. So I think you need to differentiate always, and this is what I keep on reinforcing in the book. There is nothing wrong with a set and forget if you want to buy the S&P 500 or the ASX 200, as long as you understand what is in there underneath. That phrase, when I said set and forget approach doesn't always work, was more to do with actual share picking.
Yeah. Right. Okay. Yeah. That is not sensible for obvious reasons.
But you'd be amazed by how many major funds, they just kind of sit there and,
Yeah. Fair enough. Well, don't do that. So I'm interested to pick up on Bryce's point there, because it is a phenomenon, obviously not so much in individual retail investors, but you see it a lot in big institutions and endowments and stuff in terms of chasing performance, where they have a fund that underperforms for a couple of years, so they cut their loser, and then the fund actually starts performing well, because strategies don't perform well every year, but over time they will perform well at different times. And so they keep chasing performance. How do you differentiate between not chasing performance and cutting funds that will go on to do well, and actually just cutting losers, which are bad and you should cut them?
Gee, nice easy questions. Yeah. I think you have to understand the style of investment management that the fund is doing. Okay. So this goes to the value growth argument. One of the reasons why you guys like Magellan is that they are growth fund managers. There are plenty of value fund managers out there that have been struggling to perform for ages.
Value has underperformed for so long at this point. It's like,
Get over it. It's done.
I know, but there's always this hope, and we'll get to it later on, where you're going to have the reemergence of inflation, and we're going to go back to the old days when the cyclicals are really, really going to run. And unfortunately, I mean, I'm no economic expert, but I just don't see that happening at the moment. So that's the whole point. You have to understand the style of management of the fund. You have to understand the index that it's benchmarked against. So there's a few Aussie fund managers that say, oh, we've outperformed. It's because the Australian market, because they're all invested in US shares and the Aussie dollar was going down. So again, it goes back to doing a little bit of homework.
Yeah.
So to close out the managed versus passive element, if you were a millennial just starting out and you wanted to build a high growth portfolio, how would you think about index investing versus active management? And perhaps could you provide a couple of examples of how you might put that together?
Yeah, I think you start, depending on how much money you have, you start with an ETF because it's just easy. You can put in $500. And I think once you get enough into that ETF, you have to choose whether it's 2,000, 5,000. Then you can start to diversify directly into shares. Again, once you start to do that, the shares will have a disproportionate impact on the portfolio. So you have to get used to the comfort. Suffice to say, look, I don't know what's going to happen with the US election, etc., but I remain really a long-term bull in this new environment that we have for investors, which is the capacity to invest in places like the US. I really would say, if you're young, that is still the place to go, in my humble opinion. You've got some currency risk, but if you go to an ETF that manages the currency risk and you target out, the themes that you like, which is so easy now. I mean, once upon a time, nobody could do this stuff. You guys don't realize how lucky you are. You had to be seriously Jamie Packer to ring the stockbroker and say, hey, mate, can I have some Amazon? Whereas now, okay, you can't necessarily buy an Amazon share, but you can buy Amazon as part of an index.
Yeah, well, we like to say it's as easy to buy an Amazon share as it is to buy something from Amazon these days.
Oh, well, there you go. Absolutely. But you're right, it is.
Yeah.
And it's one of the themes of how much disruption has actually happened in the finance industry.
Well, 5 years ago even, I think the main broker was CommSec and it cost $30 a trade or whatever it was. And so you were just like, well, I'm not even going to bother, but how boring is the ASX 200?
Yeah,
So.
and it really is, and it's hard because there are some great companies listed in Australia, and there's more good companies coming, and I really hope we get a political backdrop and framework to actually get the Atlassians of the world happening here in Australia, so we don't have to go over to the US and buy a company that's literally going to be based around the corner.
Yeah. Moving on to another sort of big theme in your book, there's a lot in here about how you need to think about investing, and some things that are important and some things that aren't so important. To start this section, a common question we get is around when to buy, when to sell, like how do you actually know what's important news and stuff like that. Do you have a strategy for entering and exiting, and that's probably very context specific, so I guess how do you think about it generally?
So we're talking funds, ETFs, rather than stocks?
Let's start with individual stocks because
I think
entering funds is sort of like timing the market beats timing the market, with index broad market ETFs. But I think with stocks, there's a little bit more
question would
there.
definitely apply to stock specific. We get a lot of listeners who are like, I've just made 20%. Do I let it run? Do I sell? Or vice versa? I've just lost 20%. Do I let it run?
And it's really hard at the moment because the runways are always much longer than what you expect.
Yeah.
So, hello, hands up anyone in here who thought Afterpay would be where it's at. You did think? Good lad. Well, well done you.
Very early, yeah.
Yeah, no, well, I've been in and out, but I got out ages ago for various reasons. But it is really hard, I hate to say, to differentiate between the game changers and those that are the Me Too's. When you start to invest directly, you need to sit down and say, how much money do I have? It's really basic. How much money can I continue to put in? Then you get your group of stocks of how you want to asset allocate. So $10,000, you might want to have 10 stocks in there. But if you like to really have a go, then you halve the amount of stocks, okay? If you're really bullish about your stocks. Times when you buy it, well, that is can be challenging to say the least. Good shares can keep on going up for a very, very long period of time. I know CSL is probably a bit dull and a bit boring for the millennials. It is an amazing company. It has made so much money for people. I'm not saying you go out and buy that tomorrow, but the point is that people have been saying for 20 years it's too expensive.
Yeah.
And I've seen presentations where the good stocks in Australia, the car sales, the REA, the ResMed, Xero, CSL, you could have pretty much bought those shares at any point in time over their history and you would have made money. Now, there is a difference between buying those larger companies versus starting to play around in the smaller caps. There, I think you have to be really, really careful. And at the moment, once upon a time, you go 20% is great. At the moment, that's just looking like ridiculous because there's so much liquidity around. It's such a bull market. I actually bought a share in the US, and I think this is a good example, called Livongo. And it's kind of like a telehealth company for specializes in diabetics, etc. So I bought that at $39. It went to $75. It's been one of the top performers. I sold half of the shareholding last night or early this morning. So I took out my original capital and I'm just sitting there with the profit in there because there is nothing wrong with taking your original capital out and you can put it to work somewhere else and just let the profit run.
Can I ask about that though? If your original thesis hasn't changed, like if you think
Why would you do it?
Yeah, like why would you take half of the capital out?
Because you will find that with the best will in the world, even some of the great stocks, at the moment they can have very hefty sell-offs. So if you can handle 35, 40% pullback, that's great. You can put more money into it. And this is why there is no specific answer to this question. It's a very personal thing. And everybody has a different risk tolerance in terms of how much they can see their paper profit disappear. It's going down, it's going down. So another case in point, I own Beyond Meat. I did incredibly well. I sold half of it. The other half then disappeared off the face of the planet in March. Dumbo here sold it, only watching it go through the roof again.
Oh, that is a killer.
But you know the funny thing, so this is a really good, interesting story. I'm allergic to them. So I ate a Beyond Meat burger and I got lots of jip on Facebook from older people going, oh, you can't eat that crap. But actually, I actually got an allergy and then I Googled and discovered that some people are.
No way.
Yeah, so the funny thing was I thought, well, maybe it is not the... Well, I don't know if you short them. That's a bit risky too.
So
but
in that whole theme of invest in your circle of competence, there was no way that you could know about this because you were allergic to it, but you still made the bet.
Yeah, well, I didn't know at the time until I bought the shares, made a lot of money, and then I tried it and went, I'm not so sure about this. But I guess the point is the numbers in the book would show, I think if you invested $3,000 in CSL at the original IPO, you would have over $1 million now. So that's a classic case in point. If you put $3,000 in, it might seem a lot at the time, but if you sat with it. And unfortunately, I don't think there's a silver bullet to pick those ones.
Yeah. Let your winners run. You mentioned the asset allocation, another big question that we get from our listeners. Do you have a general rule of thumb that you could perhaps talk about when it comes to asset allocation? Someone who might have $3,000 and they say, how much should I be putting into individual stocks, for example? Is there a way that you would think about that, or is again a very personal thing?
As I mentioned before, if you have $3,000 and you put $1,000 in per share, clearly those 3 shares will have a high impact on the portfolio. So you could have one that goes up and 2 that turn to muck, right? So you're going to lose money. Basically, the more shares you have, you limit your upside, but you also limit your downside. So you need to find a comfort level. And I say to people, you might want to have your core portfolio and then you have a little trading account somewhere where you punt and you say, look, I've got $1,000. I'm going to throw it at a few things, see what happens. But what you don't want is ending up with 40, 50, 60 stocks and a whole lot of ones that have completely bombed out and are never going to see the light of day.
I liked in your book you had a low maintenance, medium maintenance and high maintenance portfolio construction, and that sort of echoed that whole core and satellite approach where, if you want a low maintenance portfolio, you had 80 to 100% just allocated to ETFs and then a little trading portfolio. But if you wanted to go more high maintenance, you have the core, I guess, to call, for want of a better term, of ETFs is lower, up to 40%. And then the trading account is a lot bigger, 60%.
Absolutely.
More risk, more maintenance, more time.
Yes.
But potentially more upside.
Just like you, Ren, a high maintenance kind of guy.
I'm very high maintenance.
But it's absolutely true. And, you have to get a comfort level. You have to get your confidence. You've got to like reading. Like, I really like the fact that you guys said you like to read. It is so important.
Yeah. John Hempton, the Australian short seller, said, if you want to start learning about investing, you have to read 5 investing books. It doesn't matter which 5, you just have to read 5. And I like that. I think that's good. It's a good rule of
But
thumb.
you've got to be careful what you read because a lot of them are out of date. No offense.
This book is timeless, so it won't go out of date.
Exactly. My book, Simplicity.
Before we move to some broader macro questions, we obviously love stock-specific chat, and it would be great to get an idea of what is exciting you on your watch list at the moment. Perhaps if you could give 2 or 3 stocks.
To be clear, Bryce wants 3 game changers like CSL and A2.
I am going to write. This is true.
Gee, that's a bit tough.
No pressure.
No pressure.
No.
Okay. Well, and it's really tough too on the market on the 2nd of July when everything's going through the roof. Okay. So in terms of 2 largest stocks that I think have got good long-term growth runways, NextDC, which is the data center operator. I think Craig Scroggie, I know he's copped a lot of bad press, but I actually think the guy's very impressive and I think he's very switched on. It's a big secular growth market. Everybody knows that. It's had a bit of a run, but ultimately that will probably turn into the same as Equinix, which is over in the US, which is a major player there, and it becomes a high dividend paying stock down the track. So when you're investing when you're younger, at some point in time, you probably do want to have shares that pay you a dividend. So if you can buy a share now in your early 30s, that by the time you're 50 is on a 20% dividend yield, wouldn't you take that? Because then you get the income. So NextDC is one. Xero, which you all know about. Again, it's run really, really hard. Looking at the contactless payments and the new growth in the payments market, EML is looking quite interesting again.
Keeps popping up.
Yeah, but I had a look at 2 other ones. One I own, Osteopore, which was up about 100% today.
Well, not a bad
today.
day.
Yeah.
I mean, compared to some of the stuff that's going on at the moment with these 1,000, 2,000% increases in the micro caps or small caps.
Yeah, but you just get blowing up there.
Yeah.
You get blown up. You've got to remember when you go down to the small caps, when the market sells off, you cannot get out of those stocks.
Yeah.
So you really, really need to look at liquidity. So Osteopore, I read about it in one of the financial mastheads, take a guess. And one of the investors is one of the management of ResMed. So they do 3D printing of bones to be implanted, and they've gone into a deal in the US. It wasn't performing well, but they've just done a deal with a big insurance company over in the US. So I like the fact that the management seem to be very, very good. They've got some blue buds on the team that have a track record, and one of the guys from ResMed has actually, got skin in the game, and that is one of Australia's top healthcare companies that is also moving into telehealth. Really important. The next one is also in the telehealth sector. I don't know a lot about this. I only came across it yesterday, called Media Advisor. And this is a pharmaceutical online app, because one of the biggest problems, particularly with older people, is that they can't take their medication. So they have an online app which basically tracks older people taking their medications. They help them say your script needs to be filled. Have you taken your 5 tablets? So as opposed to the little pill box where everybody has your pills laid out. And again, it is, I think, done a deal over in the US. So one of the biggest growth markets at the moment is in the whole thing of medicine going online and the interaction between the patients or the consumers and the suppliers of either the service or the product. So there are a couple of small ones for you.
Yeah, I was going to say, so MedAdvisor has a market cap of 135, and the other one was Osteopore was, I think, 85 million or 90 million.
Yeah, so they're like,
stage.
I'm literally giving you 2 ideas. I don't know much about MedAdvisor, but to me, conceptually, It looked very interesting. But again, don't put your life savings in there.
No. Well, if Bryce put his life savings in it, he would own the whole market cap.
Oh, ha ha.
So, Danielle, let's just move to a couple of macro questions because there's obviously been a lot going on in this space, and then we'll head to our final three. What has COVID taught you about investing?
Yeah, I have been really surprised by how humanity adapts and adapts really quickly, which I think is really positive, how companies can move so swiftly to adapt. So the ingenuity and how this whole thing has played out. Only a year ago, I suggested to a major institution that should remain nameless, we should have a Zoom meeting for all its members. They laughed in my face. I'm a shareholder. Who's laughing now?
Yeah.
Okay, so it's the ingenuity, it's the rate of change that has actually taken place. I think sometimes it's very good to be optimistic, to be a half glass full person. So whilst the whole COVID thing has been terrible for so many people, on the other side of the equation, there's a lot of amazing stuff actually happening. So I think I've underestimated the capacity for humanity to adapt, change, and that goes for the corporates as well, and to solve the big problems and actually forge ahead. So if anything, it's actually made me more bullish.
Yeah, nice.
Looking back over COVID, and this book you wrote before COVID and released just before COVID. Is there
Just after.
Oh, sorry, just after. Is there anything you would have changed in the book if you were writing it now rather than before COVID?
No, obviously, the major infrastructure assets like Sydney Airport and Auckland Airport and Transurban, hey, who would have thought we're not going to fly? And, international travel's off the cards. The concept was right. There are some infrastructure plays around the world that are still looking really, really good. But no, I think all the themes have stood the test of time. But do differentiate that what I'm seeing at the moment in share markets are very, very frothy bubbles starting to appear. There's a huge amount of cash piling into shares at the moment. There's nothing wrong with that. But just remember to keep your head because it can go either way. And I've seen it in emerging markets. We just literally got overwhelmed with the institutions wanting to buy shares. And because the liquidity isn't there, the shares go up a lot. So I tend to be more conservative by nature. So just remember that it's quite frothy.
Yeah, on that point of frothiness, obviously the US Federal Reserve has just pumped unprecedented levels of liquidity into the market. There's a saying, don't fight the Fed,
yeah.
and it has well and truly proven itself here in this market recovery. How do you think about investing when this institution is just pumping so much money into the market? Does it just erode the need to do any actual analysis? If the Fed's putting $1 trillion in, stocks will go up? Or how do you think about investing at a time like this?
I think you have to say it's not that the Fed is going to stop, but there could be a massive disruption again in the market, which happened in March. So you had a few major hedge funds that came unstuck. So they became forced sellers. And that's why the Fed had to come in because there was gridlock in the system. And that creates total financial collapse. When the tide goes out, as I say, you want to be holding the shares that have strong balance sheets, that are not fly-by-night, that you can kind of sleep well at night with. And I've applied that principle time and again over the years. And the same in emerging markets. You want the companies that are going to be able to keep on functioning even in the most distressed times. So again, it goes back to your asset allocation. That's fine. Play around in the more sexy, more racy stocks. But if they make them your whole portfolio and there's another event like we had in March, a black swan as they call them, then you might find you're down 70%. A la the dot-com crash, 70 or 80%. And that can be very painful.
Yeah. We had a saying in March, when stocks were cheap but everything was falling, it was look for companies that will survive in the short term and then thrive in the long term.
Absolutely. And the good companies, they are just doing that at the moment. You see them taking advantage, literally, of the weaker ones. Just look at Amazon. It's like Pac-Man.
It's nuts. Yeah.
It is nuts.
It's
crazy,
it
might attract antitrust legislation down the track, but these big companies, this is what they do. The banks did it in the GFC. They actually went and had all these acquisitions of all the smaller banks. So you want to be with the strong players that are actually going to become become stronger during this period of disruption.
Yeah.
So to close the macro section out, Danielle, Ray Dalio, very famous investor for those who've just joined the show, go and look him up. He thinks that stocks are in for, quote, a lost decade. What are your thoughts on that?
Yeah, I hadn't actually read it. I think Ray Dalio is great because he's a big thinker, and I love big thinkers. I think a lot of what he has written about here is he's going back to the 1970s. We are at a period of stagflation. So you have high inflation and you have low economic growth. There was also, I think, an assumption that margins have been squeezed as much as they can. And really, we've had it as good as it can get. Inflation, who knows? I don't see any inflation. I don't see any demand inflation at this point in time. There's a big question mark over the Fed printing, and if it goes to an MMT scenario, modern monetary theory, where politicians get their hands on money, whether or not it will actually result in inflation. But, you know, I don't see it as a lost decade. The other point to make is that, you know, he's Jim Cramer. I love Jim Cramer in the States. You've got to say, he calls out the billionaires and he says, guys, hello, you don't need to make more money. You can make these big calls, but the people in the streets need to invest. They need to put their savings somewhere because you're not going to get it in the bank at the moment. So I think, like anything, you've got to keep your eye on the ball. If suddenly there is inflation, you could well see a big change in the market, particularly interest rate sensitive stocks. But at the moment, I don't think, you know, the lost decade is here.
Fair enough. Bryce's portfolio is half Bitcoin, half gold. He's
Well,
taken
there
that
you
lost
go.
decade.
I'm sorted.
Yeah. So, Danielle, we really want to thank you for coming on. As Bryce said, we have a final 3 questions that we'll ask. But before we do, we should just give the book another shout out. So it's called Shareclicity. Can be bought at any major bookseller, Amazon,
Online.
Everywhere.
Yep.
We're everywhere where good books are sold. People should go and check it out.
Yep.
If people want to read more from you or follow you, are you active on any social media?
Yes. I've got the website, shareclicity.com.au. So there's a lot of media articles there, and I will be starting a blog going forward. I'm also on Twitter, and that is Danielle Ecuyer at Shareclicity. Facebook, Shareclicity, really easy. Instagram, Shareclicity. LinkedIn, Danielle Ecuyer. So yes, I'm plastered everywhere. So yes, the plan going forward is to continue to do in the capacity that, quote unquote, I am not a registered advisor, very important, but I will be doing blog articles for investors on topics that I think are important and relevant for investing.
Nice.
Great. So we'll get stuck into these final 3 questions. And the first one we like to ask is, do you have any must-read books? And you can't say your own, unfortunately.
No, of course. No, that's fine. The funny thing is, because I was in the industry, so to tell you the truth, I have not read all the classics, okay? Probably not, you know. However, I am a big fan of Michael Lewis. Everybody can do themselves a favour. Read Michael Lewis. It's real stories. They have happened. You can see how psycho the finance industry can be.
Sounds epic.
And so I love Liar's Poker, The Big Short. Everybody has to read The Fifth Risk. Really have to read that. Now, the next book, I haven't read it. It's only just come out. I listened to the podcast today. Victor Schvetz, he is the global strategist for Macquarie Bank. He used to be our head of research at Barings. He has written a book called The Great Rupture. And
Alan Kohler podcast?
Yes. Everybody must listen to it. Everybody must read the book. This guy is, having worked with him, and a few of us, you know, our eyes used to glaze over. He is a intellectual giant, and he combines the history of humanity, the history of financial markets, and the dramatic change that is going on at the moment.
Wow. That is
And Bryce is going
that's
to
a big
sleep.
topic. Sounds good. I've just looked it up. I'll pick that one up. So the next question we like to ask is, what's your go-to source for investing information?
Australia or US?
Oh, interesting.
Well, they're very
we'll take
different.
both answers, yeah.
Yeah. Okay. In Australia, I have a go-to basic one, which is FN Arena, because it does all the broker calls. So it gives you all the broker recommendations and share price targets for over 400 companies. So it's the go-to website where I can glean very quickly what brokers are saying about shares, where they are relative to their moving price averages and their share price targets.
Is that free?
No. It's behind a paywall, but like anything, one good trade, you've paid it off.
Yeah.
There's a free trial.
Yeah.
Nice.
And I think you have to understand that it's like anything in life. You pay for something good.
Hey, we're a free podcast here.
I know, it's such well, yes, exactly. I'm sure down the track there may be some monetization of the product. Otherwise, then I kind of go through Livewire, I read that big financial masthead, and I'm just constantly, gleaning stocks. Over in the US, I use CNBC a lot, and you can, again, it's free unless you go behind the paywall, which I do, because, again, it does a lot of broker recommendations. I think for investors, you'd be amazed by how much information you can actually get by looking at the companies themselves. And you listen to the management being interviewed. It's one of the best ways to get an idea of what good management is and maybe what not so great management. And I've got an example in the book of a CSL interview of the CEO and the CFO. And I actually highlight all the things that came out of just listening to them being interviewed that you can cite of what makes a good company.
That's cool. Yeah. And then the last question we like to ask. So if you think back to your younger self making your first investment in an orbital engine.
Such a chick thing to do. Not.
What advice would you give your younger self?
Yeah, it was funny. I asked my son that because he goes, buy the bleep dip.
Yeah. FANG stocks are going to be big one day.
I think at the end of the day, you've got to trust your own opinion. You've got to realise that the experts are fallible. They can make mistakes. This is not about perfection. This is about managing risk for yourselves. The biggest things I did, I never trusted my own opinion enough. And I think people should never do anything that they're not comfortable with. And buy the dip.
The most important one. Well, Danielle, thank you so much for your time this evening. It has been a great conversation, one that I'm sure our audience will get a lot of value out of. We've covered a lot and very much appreciate you coming on the show.
Pleasure. Thank you for having me, and I hope it helps.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.